Okay, so this is going to be specific to the indirect method of preparing. So the issue here is how to prepare the cash flow statement. So this is something that you need to know. How do we get the information we need to prepare one? Well, that's what these three sources are telling you here. We're going to need something called a comparative balance sheet. So this year's balance sheet compared to last year's balance sheet. We're going to need the current income statement for the current fiscal year that we're in, and there may be some additional information that's provided to us that'll help us prepare this. Okay, so we're going to move on to if you're in the book, this is page 596. Okay, so the major steps in preparing the cash flows. Okay. So step one is we have to determine the cash either provided or used by operating activities. Okay, and the way we actually do that is we start with the net income, but it's weird because all this time you've been learning the accrual basis. And in the cash flow statement, we actually need to convert the net income from the accrual basis to the cash basis. Okay, so it's a very interesting type of thing, and these are the steps that are going to be involved in it. Okay, so so that's actually the first thing that we're going to be looking at. The second thing we're going to be looking at here, step two, as you'll see it when we actually do it, we're going to analyze the changes, right, in asset and liability accounts. And we're going to note any investing or financing activities that we see with these changes. Okay, and that means we're going to be using that balance sheet and other information for that, as you'll see. And the third step that we're going to need to do is we're going to compare the change in cash, that's the actual cash balance, the cash account balance, on the statement of cash flow with the change in the cash account that's reported on the balance sheet. They should agree. They should agree. And you'll see that as well. Again, that information will come from the balance sheets. So those are the things that we're going to be looking at here. Most companies actually will do both the indirect method and the direct method of preparing the cash flow statement, but the indirect method is the most popular because it's simply easier and less costly. Okay. It also focuses on really the operating activities a lot more, which is technically probably one of the most important parts of a business, right? It needs to be operating soundly. So we're going to be looking at that a little bit more too. So here, now this starts our computer services company. So this is the illustration on page 597. If you have your book, this income statement is there, and it shows us, right, our sales revenue and all the way down to our net income right here. So this you'll need to look at page 597 for. That's the income statement. The next thing you're going to need, also on the same page, again, page 597, is the comparative balance sheets, right? So here's the comparative balance sheets for the most recent 2-year period for this company. And notice that the numbers in each column are specific to the assets in that year. And on the far right side, the changes are noted because those changes are very important in the cash flow statement. This is also on page 597. It's just not set up in the same way as the last slide, but it should. This is the liabilities and stockholders' equity section of the same balance sheet for the same 2 years, and the changes noted on the right side in all of those accounts. Okay. So the changes are noted from 2016 to 2017. And so if you look at the first account here, accounts payable, for example, so you can understand the change. If you start at $12,000 of accounts payable and you have $28,000, it was an increase from 16 to 17 that year of $16,000, right? And if you had $8,000 in taxes payable and it went to $6,000 in taxes payable, your taxes payable decreased by $2,000. So that's what we're going to be noting. All the changes need to be read that way. Okay. And then this is the additional information that will be provided to you in this case, for 2017, the most recent year. This is also on the bottom of page 597. And you think after writing it a few times, I get better at it, but I think my writing sucks. What do you think? Don't agree. I already know. You already know. Okay. So here you have depreciation expense for building and for equipment. Here, the second piece of information that's important is the company sold equipment, right? With a book value, that term comes back a lot, right? Of $7,000, but they only got $4,000 in cash for it. Looks like they issued bonds in direct exchange for land. So they went bonds for land. So no cash involved in this, right? It's just bonds for land. That's it. The fourth one here, they bought a building for $120,000 in cash, and they bought equipment for $25,000 in cash. Number 5 here, they issued common stock, so they sold common stock to investors for $20,000 cash. And the 6th one here is they declared a dividend and paid $29,000 cash dividend. So these 4 pieces, these 4 slides are all on page 597, which of course I marked very clearly up here. No, but it's there and it's in your book. So I reference that. Okay, so with all of that information, and that's the starting point, is making sure you have all that information. Now we can do step 1 that we were introduced to earlier. Okay, step 1, operating activities. Lots of slides. Determine the net cash provided or used by operating activities by converting net income from the accrual basis to the cash basis. It's a big deal. That's why it takes a little bit of time. The good news is it's all listed here for you. So it's not going to be like, what was that? It's right there. It is the same process every time. So that's really a good news for everybody. So here are the adjustments that we have to make to net income to convert it from accrual to cash. Okay, so we have a right number. So the first thing that we do is we're going to add back all of the non-cash expenses. And the biggest non-cash expense that we have is depreciation expense. Now think about that. A non-cash expense is an expense you don't have to write a check for, right? So when you have rent expense, you're writing a check. When you have salaries and wages expense, you're writing a check. In the case of depreciation, you're not writing any checks, nothing. So that's a non-cash expense. We're going to add that back because literally the cash never went out, stayed in. So that we're going to add back. One little adjustment we have to make too here is we're going to be deducting any gains and adding any losses, because we would normally add the gain to the income statement or subtract the loss to the income statement, but we have to reverse those. That's what that's about. And then we're going to analyze those changes to the asset and liability accounts, and add or subtract those back, as you'll see. It's fascinating, really, really, really. Okay, slide 2. Which is an example of a cash flow from an operating activity? Ooh, ooh, ooh. Does anyone know? Nobody's talking.
D?
It's A, right? When we paid interest to a lender, it was a good try though. When we paid interest to a lender, what did we do with the interest? We expensed it, right? Interest is an expense. And so it would be on the income statement. And so basically that's an operating activity. Paying back the loan is a financing activity. Paying interest
was
on
thinking
the
interest was financial.
well, the interest is the cost of the loan. So we expense the cost of the loan. We expense the interest. We pay back the loan. That is a financial activity. So if I pay back a bank $100,000, that $100,000 is a financing activity payback, right? But the interest on that is not. The interest on that is an expense to the business, the cost of having the loan. And I can expense the cost. That's why I have an interest expense. And so that's really the big difference in that, okay? And again, you'll get used to it. This is the first time around. Depreciation expense, again, is one of those non-cash expenses. It doesn't really come out of anything. It doesn't come out of the cash. It does not reduce the cash. So the first thing we have to do when we look at it, we take the net income for the company, and the first thing we do is we're going to add back whatever we had for the depreciation expense. We are adding it because the cash never went out of the business. The cash stayed in the business. We didn't have to write a check for this. So we look at it as a positive cash flow. We look at it as the cash is staying in, never went out. So the depreciation expense is always going to be added back in to the net income, because in order to get the net income, we subtracted it out, but we didn't pay it out in cash. So that's why we're adding it back in. So right now, we would have net cash provided just with these two things alone of $154,000. The $145,000 in net income, adding back the $9,000 we subtracted out, because it's not a cash expense. We don't write a check for depreciation.
I really don't know why we add the depreciation expense though. It's an expense, so why add it to the net income?
Because we already subtracted it out of here. So we have to add it back, because we are looking at cash. We're looking at cash. So did we have to write a check for that expense?
Oh no. Oh, I see.
The answer is no. Unlike all the other expenses, right? The rent expense, we write a check.
Yeah, got you.
Right? Any type of, even interest expense, we're writing a check, right?
Well, my logical brain says, why did we even take it out in the first place?
Well, because remember the net income, we did all of this based on the accrual system. Everything we've learned in this class is the accrual basis of accounting, because corporations have to have their financial statements done according to GAAP, generally accepted accounting principles. But when we do the cash flow statement, we have to convert that into the cash basis. So the $145,000 net income was done with the accrual system. That's how we got those numbers. We now have to untangle that to put it into the real cash basis. And so that 145,000 net income included, we subtracted out a $9,000 expense that never took any cash away from us. And so we're adding the cash back in. Okay, that's how you have to think with cash flow. Cash flow is simply about the cash in, cash out. In this case, this cash stayed in. We never wrote a check. So we add that 9,000 back in. Now, remember, if we had any loss or gain, okay, we already added or subtracted it to get net income, because remember the multi-step income statement, there's the section after the income from operation that we had other revenue and gains, other expenses and losses. So we've already added the gain into the net income. We already subtracted the loss from the net income. That has to be reversed. So because we subtracted the loss when we calculated net income, we have to add it back. And because we added the gain to the net income, we have to subtract it out. Okay, we just have to reverse what we did on the income statement, because the income statement was done with accrual basis accounting, and we are converting it now to cash. So the second thing we have to do here, in this case for this company, and by the way, if you're following, I'm on page 599. Okay, page 599. So this was actually started on 598 with this piece, and 599, page 599 is down here. And I still cannot write well with my finger. Okay. So because we subtracted the loss from the net income, this number right here, on the income statement, which we did properly with the accrual basis, we're going to add the loss back in. Okay, we're going to add that loss back in. Okay. Okay, the next step is probably the most, I wouldn't say difficult, but I think all of it's a little confusing at first, because you're looking at things from a cash basis now for the first time in the course. We've all been looking at things from the accrual basis, that we have our accrual sunglasses on, and we need to change those sunglasses to bifocals. Oh, that's a good one. I'll give myself that. Okay. All right. So that's why a lot of this stuff seems a little foreign, is because we're actually looking at it now from a cash basis when you've learned accrual over the last year. Ouch. But that's the cash flow statement. That's the way it's done. So what we look at is we look at to see if there's any changes to any of the current assets. Because if there are changes to the current assets, that means that we might have saved cash as a result of that, or used cash as a result of that. And so that's important to know, because we have to either add it or subtract it back into the cash flow statement. So this is an example of that. So here we had an accounts receivable balance decreased. Okay, so the balance on January the 1st, as you see here, was $30,000. But at the end of the year, the balance was $20,000. Okay, now that means technically, when there's a decrease in accounts receivable, it means we actually have more cash. And so any decrease in accounts receivable means we actually have more cash in. And so any decreases in accounts receivable would be added to the balance. That is on page, now we're on page 600. Okay, page 600. 600. Okay.
Can you just explain that? When accounts receivable goes down, because they've been paid. So you
Yeah,
billed somebody and
we
they
have,
paid it.
we
Okay.
have more cash. Yeah, we
Yeah,
have more.
yeah. Okay.
Mhm.
Gotcha.
Okay, so any decreases in accounts receivable mean that we have more cash. So that's why we're adding it to the cash flow. I know this is like a, you know, this chapter of all in the entire book is kind of like the one from Mars, you know, and we're so used to being on Venus or even Earth that it's like, oh my God, this is like so foreign, it's so different. But it's strictly because the cash flow statement is done on the cash basis. And that means we have to untangle all the other crap we did for all the accrual stuff that we've been doing to get the cash basis correct. So it is totally foreign. It is definitely out of our normal orbit that we're going. So I don't expect that this is going to be, you know, clear. My goal is hopefully after I explain a little bit, after you read about it a little bit, and after you do it a little bit, there'll be some type of an aha moment, like, oh, okay. And if not, hey, don't worry about it. You know, some people go through life that way. You know, but this should click eventually. I will promise you that it might take a while. You might need to do accounting and financial stuff for a while before it all clicks and it makes sense to you. It took a long time for me. So, it's just an introduction at this point. So don't worry too much. We'll see if we can follow as best we can. We'll do a preparation of one and you don't have to worry about it after this chapter for now. Okay. So here again is another non-cash current asset that changed. In this case, inventory, right? We went from $10,000 of inventory at the beginning of the year to 15,000. Oh, did I lose? I lost something. Something just clicked. Okay. There's my pen. To 15,000 at the end of the year. So in other words, we have more inventory. Okay, and because we have more inventory, it probably cost some cash. So we're gonna deduct that from our net income. And I need to get down here. So any increases in inventory basically used up some of the cash. So we would subtract out any increase in inventory, because any increase in inventory would logically mean we had to spend more cash to buy it. So we subtract it out of the cash flow for operating. More changes to current assets. So we look at our prepaid expense balances. So this is prepaid insurance, prepaid advertising, prepaid rent, supplies even. So if the prepaid expense balance increases, if we have more prepaid insurance, right, it probably costs us some cash. And so we're going to deduct that increase from the cash flow statement. But if our prepaid expenses went down, that's a different story. So here, an increase in prepaid expense means that we probably have to use cash to do it. So we would take that cash out of the cash flow. Liabilities would also change, and change in liabilities also affect cash, okay? So one is accounts payable. If the accounts payable actually goes up, that means we actually got more than what we paid for. And so we actually saved money. So we have more cash because of it. And if taxes in this case went down, that means we actually had to pay cash. Sorry, if income tax payable decreases, right? The expense on the income statement was less than the amount that we actually paid. And so we actually subtract that from the cash flow statement. So again, an increase in a payable meant that we got a whole bunch more stuff and we didn't pay for it. So the cash literally is looked at as staying in the company. Cash didn't go out because we have more payables later. But when we actually paid down the payable, we used cash. And so because we used cash, it's reduced. So the net cash provided by operating activities is calculated this way. And there's a whole, again, this part here of these adjustments with all this stuff that we looked at is always going to be available to you. Always going to be available to you.
No, I love you more. No, you're not a boy. You choose a girl.
Okay. So actually, this is on page 602. Okay. So if you are on page 602, you will see this particular illustration
Don't play that.
that tells you exactly what to do. So in the case of the first thing, non-cash charges, we're only going to be dealing with depreciation expense. Every time there's a depreciation expense, we're going to add it to net income so we can convert it properly. For the gains and losses, losses are added back, gains are subtracted out. Okay, that's for gains and losses. And for all those other interesting changes in assets and liabilities, if we saw a current asset account increase, probably because we have to use cash, we would deduct it. If there's a decrease in a current asset account, we'll add it back in. If there's an increase in a current liability, we add that to cash. If there's a decrease, we deduct it. Okay, so this list here is a summary of the whole 15 slides that we did through the book, starting on page.
Only if we used cash, correct?
Well, that's all we're doing in this chapter. Is we're converting everything to the cash basis simply so we can put the statement together.
No, just to, for example, to add the increase in current assets, if only we use cash to get those assets.
Well, these are the rules that we're following for cash flow. So there's certain assumptions that are going to be made in all of this type of stuff. So, so if we have more, say, supplies, well, then we probably ended up using cash for that, and so we're going to deduct that. However, if we have less supplies, we probably, or less, say we have less receivables, we probably ended up saving money. We're going to add that. So these are the general rules that we use when we convert our income statement to the cash basis. Okay. So we're not going to worry about a fraud, but we are going to review this. I will have some decent tutorials for you on this as well, which should be good. So if you are on if you are on page 602, This is the information at the bottom of page 602 in your book, okay? It's the Do It exercise 2A, which only looks at operating activities. It doesn't look at the other two because the other two are quite easy. We'll do that next. But here we have Josh has a Photo Plus company, right? They had net income of $73,000 in 2017. He also, on the income statement, there was a depreciation expense of $7,000. There was a gain of $2,500. When you look at the comparative balance sheets for 2016 and 2017, you have to calculate the differences or the changes from the base year to the most recent year. And so here you'll see accounts receivable increased by $3,000, accounts payable decreased, excuse me, by $3,800. And they want you to calculate the net cash provided, right? So we're going to start with the net income, right? And we're going to go through our list. So the first thing we're doing is we start with the $73,000 net income because we're calculating here cash flow from operating. So the first step, you write down your net income. Then you have all these adjustments, okay? We add our depreciation expense. So if you go back to the slide, you'll see depreciation expense was $7,000. And so here we're adding the $7,000, okay? The second thing here is he reported a gain. Let's go back. Oh, it's actually up here. The gain is $2,500 that was reported. So we subtract out the gains. Okay, we reverse them. We reverse. Then what we show is accounts receivable increased by $4,000. And so if accounts receivable increased by $4,000, let's go back to our chart. Oops, going too fast. Here we go. Any increase in a current asset account needs to be deducted. And so the increase in accounts receivable will be deducted as well from cash. And then accounts payable decreased by $3,800, and decreases in liabilities are also taken out. Okay, so when you put all these together, you had a $3,300 difference. And when you subtract that from that, your cash provided by operating activities is that $69,000. This is on the top of page 603 for an answer. So this, you're going to see this on homework, but basically it's to practice the stuff that we just looked at. Okay. The very last thing that we're going to be looking at here in the chapter is the last two parts of the cash flow statement, the investing activities and the financing activities, and how they are looked at from in the preparation of a cash flow statement. So you might remember the company here purchased land of $110,000 by issuing long-term bonds. Okay, now this was a non-cash activity, right? They bought the land by issuing bonds. It was a trade. So yes, we saw the land account increase. We saw the bond payables increase. This did not affect cash, so it's not going to show up on our cash flow statement. No cash was used. Here is the other part of the cash flow statement showing, this is on page 604. 604. No, this is not. Yes, it is. Okay, it is. It's just in a different order on page 604. So if you look on page 604, the operating activities were the ones that we went over a few slides back. This is the investing activities first. So the investing activities show a couple of interesting changes, okay? One is they purchased a building for cash. And let's see, do they actually have this? Yeah, they actually have. So this is the additional information that was provided back on page, back on page 597. Remember, we had the income statement, comparative balance sheets, and additional information. That's where this came from. So they acquired an office building for $120,000 in cash. So the purchase of this asset used $120,000 in cash. So remember, when you see numbers in parentheses here, it's just a use of cash, cash going out, cash going out. That's all it means, okay? They also purchased equipment for cash for $25,000. So you see that $25,000 is going out of the company. Oops. So here you have the purchase of the building, purchase of equipment rather for $25,000. You see the purchase of the equipment there. This was a cash transaction, so that's why you see it in cash. You also saw that part of the other additional information is they sold equipment for $4,000. Okay, it cost them $8,000, but it had $1,000 in depreciation. And so when you look at that $4,000 in cash, that affected cash. But in this case, the cash they ended up losing money. That's way too small. I'll go back here. So here's the $25,000 purchase of equipment, cash going out. The sale of the equipment, $4,000 cash coming in. So all of these are investing activities. And as you see, they actually used money, more cash went out for investing activities than came in. And so this was net cash used by the investing activities. They took $141,000 more out of the company for investing activities than coming in. Now that's, again, that's usually a very good sign. That's usually a good sign. We want to see that them using money to do appropriate investing activities, buying assets and positioning the business to be more profitable in the future. Okay. So the financing activities are next. Okay. So what you have here so far, we have the net income of the company, all the adjustments that gave us the operating activities. That was early on, right? We just looked at the investing activities of the company in this section here. And now we're going to be looking at the financing activities of the company. And only two things happened for the financing activities of the company. The first thing is they issued common stock, okay? So they had $20,000 of common stock. Actually, I think this should be on that side, right? It's a credit side balance, yeah? There's a mistake. But anyway, they sold $20,000 of common stock, bringing $20,000 of money in. So cash flow from financing activities, the first thing is a $20,000 positive number because it's cash coming in. Okay, it's not, that's the only reason it's a positive number is cash is coming in. Okay, and then they paid a dividend. And again, when they pay a dividend, that's cash going out. And so the 29,000 shows cash going out as a negative, right? So here are the dividends, say they got that right, showing the cash going out. And so the total for the financing activities looks like they used $9,000 of cash for financing activities. They used $141,000 for investing activities, and they were provided $172,000 of cash from operating activities. So these totals become important because that's what this number is. In this case, we have, this is a bigger number than these two combined. And so we have a net increase in cash, $172,000 from operating activities, minus 141, minus 9 gives you $22,000 difference. This $22,000 is an increase in cash. You started the period with $33,000 in cash. You just increased it by $22,000. So now your cash is $55,000. Okay. Okay. All right. So the net change in cash, which is what we looked at, right? The $22,000 increase will show on the balance sheet. So you see in 2016, they had the $33,000 of cash. In 2017, they ended with $55,000 in cash, $22,000 increase from 16 to 17. That's exactly what this slide, this part of the slide shows us. They started with 33,000, they ended with 55,000 to $22,000 increase. That's where those numbers come from. And of course, this would be the cash on the balance sheet. And that's it. That's all we're doing for this chapter. So I'm going to stop actually just record.